With the United States national debt officially spiraling past $38 trillion, the financial playbook you used for the last decade is now completely obsolete. Investors who continue to ignore the precious metals sector in 2026 are risking a catastrophic loss of purchasing power that no amount of traditional stock diversification can fix. While physical gold has been breaking record highs, there's a much bigger opportunity hiding in plain sight that most retail investors are completely overlooking right now. I am talking about high-quality gold production stocks that are currently trading at valuations we have not seen since the precious metals bear market of 2015. In this video, I am going to break down exactly why I am aggressively rotating capital from the Magnificent 7 tech stocks into a specific basket of undervalued gold miners. We will look at the massive divergence between the price of gold bullion and the mining companies, and why this gap is mathematically destined to close in the next 12 months. I am also going to reveal the 3 specific types of gold assets I am buying for 2026, ranging from ultra-safe royalty companies to high-octane production plays. But before we get to the specific stock picks, we need to understand the terrifying macroeconomic reality that is forcing the Federal Reserve into a corner they cannot escape. For the first time in history, the interest payments on our national debt have exceeded $1 trillion annually, consuming more of the federal budget than our entire defense spending. This creates a scenario known as fiscal dominance, where the central bank can no longer raise interest rates to fight inflation without causing the government to default on its debt. This is the perfect storm for gold because it means the dollar must be devalued to keep the system afloat, regardless of what the Fed chair says in his press conferences. However, simply buying physical gold bars or a basic ETF like GLD might not be the most efficient way to grow your wealth during this specific phase of the market cycle. While physical gold offers incredible safety and insurance against currency collapse, it does not produce cash flow, it does not pay a dividend, and it has zero operational leverage. This is where the gold mining sector comes into play, offering a mechanism known as operating leverage that can potentially turn a 20% move in gold into a 100% return. To explain this simply, imagine a mining company that has an all-in sustaining cost of $2,000 to pull a single ounce of gold out of the ground. If the price of gold is trading at $2,500, that miner is making a profit of $500 on every single ounce they produce and sell to the market. But if the price of gold rises just 20% to $3,000, their costs remain relatively fixed, while their profit margin explodes from $500 to $1,000. That represents a 100% increase in net profits from only a 20% increase in the underlying commodity price. And that is the magic of mining stocks. Right now, we are seeing a historic disconnect where gold prices are sitting near all-time highs, yet many mining stocks are still trading as if gold were $500 lower. Institutional investors have been slow to return to this sector after being burned in the past, which has left these companies trading at some of the lowest price-to-cash flow ratios in history. So, how am I positioning my portfolio to take advantage of this setup without taking on the excessive risks that usually come with investing in the volatile mining sector? My first and largest allocation for 2026 is going into the gold royalty and streaming companies, which I consider to be the absolute best business model in the entire industry. Companies like Franco-Nevada and Wheaton Precious Metals do not operate mines. They do not drive trucks, and they are not exposed to the risk of rising fuel and labor costs. Instead, they provide upfront capital to miners in exchange for the right to purchase a percentage of future gold production at a deeply discounted, fixed price forever. This business model essentially acts as a free cash flow machine that benefits from the upside of gold prices while being completely insulated from the inflation that hurts traditional miners. Franco-Nevada, for example, has arguably the strongest balance sheet in the sector, with zero debt and a diversified portfolio of assets that spans the entire globe. In a year like 2026, where cost inflation could continue to plague the broader economy, these royalty companies offer a defensive moat that is unmatched by any producer. You can think of them as the software companies of the gold world because they have incredibly high margins, low employee counts, and infinite scalability across different projects. My second key allocation is targeting the senior gold producers, specifically the industry giants that have cleaned up their balance sheets and are now focused on returning cash to shareholders. For years, the major miners were criticized for reckless spending and empire building, but companies like Newmont and Barrick Gold have drastically improved their discipline recently. Newmont Corporation, as the world's leading gold miner, offers a compelling dividend yield that effectively pays you to wait for the market to wake up to the company's true value. These senior miners have the scale and the reserves to withstand short-term volatility, and they're the first places generalist funds will look when capital finally rotates back into gold. I am specifically looking for senior miners that are trading at a free cash flow yield of over 10%, which provides a massive margin of safety even if gold prices consolidate. The math here is simple. If a company can pay a 3% dividend and buy back 5% of its stock annually, you are getting an 8% yield before any price appreciation. However, investing in producers does come with specific risks that you need to be aware of, particularly geopolitical instability in the regions where these mines are located. We have seen governments in Latin America and Africa demand higher taxes, or even threaten to nationalize assets when gold prices rise, which can crush a stock overnight. That is why I strictly limit my exposure to companies with significant portions of production located in Tier 1 jurisdictions like Nevada, Canada, and Western Australia. The third component of my 2026 strategy involves a smaller, speculative allocation to the Junior Mining ETF, known by the ticker symbol GDXJ. This fund holds a basket of mid-tier producers and exploration companies that offer the highest leverage to gold prices, but also come with the highest volatility and downside risk. In a full-blown gold bull market mania, these smaller stocks can easily double or triple in value in a very short period as retail investors chase the momentum. However, this is not an investment for the faint of heart, and I treat this portion of my portfolio like an option contract that could either expire worthless or pay out massive returns. Now, you might be asking yourself why you shouldn't just buy Bitcoin instead of gold if you are looking for protection against currency debasement and government spending. While I am also bullish on digital assets, gold plays a completely different role in the portfolio because it is a non-correlated asset with a 5,000-year history of success.
Can't be right.
Central banks around the world,
overnight.
from China to Poland, are buying gold at a record pace, and they are not buying Bitcoin to back their currencies and diversify their reserves. This central bank demand created a natural floor under the price of gold, reducing the downside risk in a way that purely speculative assets simply cannot match. My strategy for 2026 is to hold approximately 15% of my investable assets in this precious metals complex, split between royalties, majors, and the physical metal. The goal is not to bet the farm on the collapse of the economy, but to have an insurance policy that also happens to be one of the most undervalued sectors in the market. Another major catalyst we need to watch this year is the potential for resurgence in mergers and acquisitions as the major mining companies run out of reserves. Because the industry has underinvested in exploration for the last decade, the big players will be forced to buy smaller companies to maintain their production levels. This M&A cycle will likely drive up the premiums for high-quality mid-tier miners, providing another layer of potential upside for investors holding the GDXJ ETF. It is also worth noting that energy prices play a huge role in the profitability of these miners, as diesel and electricity are two of their largest